Now let's look at intra-entity debt transfer. There are two types of intra-entity debt transfer. One is the direct intra-entity debt transfer. The other is the indirect intra-entity debt transfer. Please take 1 minute, try to think about what may be the difference between these two. So the direct kind of intra-entity debt transfer is, for example, we have a parent and we have a subsidiary. It is either the parent issued debt and that debt is bought by the subsidiary, or the subsidiary's debt is bought by the parent. So that is the direct intra-entity debt transfer. And then the indirect intra-entity debt transfer is, for example, the subsidiary issued debt to some outside party, and then the outside party, the parent bought those debt from the outside party. Or it can be the parent issued debt to the outside party, and then subsidiary bought those debt from the outside party. So that is the difference between the two. And as you can see here that the direct type of intra-entity debt transfer is pretty easy. We just need to cancel, like put the parent and subsidiaries financial statements together and then cancel out. So for the subsidiary, if it is downstream, for the parent, that may be debt payable, bond payable, and for subsidiary, that is its investment account. So we just need to cancel out the corresponding amount from those two accounts. For the indirect kind of intra-entity debt transfer, that is a little bit more complicated. And then the indirect kind of intra-entity debt transfer is the focus of we're going to talk about in this class. So let's first talk conceptually about what is happening here when there's indirect intra-entity debt transfer. So the indirect intra-entity debt transfer is basically, as I said, it is when one company acquires an affiliate's debt instrument from an outside party. So what is essentially happening here is from the consolidated perspective, so the parent and subsidiary, if its subsidiary issued the debt and the parent bought it. So from the consolidated perspective, if you view the parent and subsidiary as one firm, it's basically you issue the debt and then you retire the debt yourself, right? So the debt is retired as of reacquisition date. That is if you view two firms as one firm. However, if you view the two firms individually separately, on the acquirer's book, so in this case, it is on the parent book, the parent, when it acquired the debt, it is recording it as an investment bond. And then on the debt issuer's book, in this case, subsidiary's book, subsidiary is still recording it as a debt or bond payable. So this is what is happening here. If you look at two firms as different firms, you are going to have an investment account and you are going to have bond payable. And then also every year you are going to, for the parent, you are going to receive interest and then you are going to record interest revenue. However, for the subsidiary, you are going to pay out interest, so you are going to record interest expense. However, if you look at those two firms as one firm, you issue the debt and then you retire the debt. As of the retirement of the debt, this debt no longer exists. So there should be no investment account, no bond payable, no interest revenue, and no interest expense. So in the consolidation process, we need to eliminate all of those. So this is just a conceptual view of what is happening here. And then we're going to talk about what we do in the consolidation process.